Hello and welcome everyone to this weekly market recap for the week ending Friday, March 21st, 2025. I'm Tom Boley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to be with all of you again this weekend. Taking a look at what happened this past week. Of course, we had the Fed meeting that came and went on Tuesday and Wednesday. Of course, there was no change in interest rates on Wednesday, but that was widely expected. No one was really looking for a change. I think some were hoping, including me, that maybe the Fed would start talking a little bit more about rate cuts, but really they just kind of left it saying that they would be looking at still cutting twice later this year, that they still got an eye on inflation and so forth. And I'll show you the statement that was made here in just a few minutes. But overall, I don't think there was a whole lot done. They did agree to cut back on some of the redemptions of their U.S. Treasuries, signaling quite a potential cutback there. I think that was beneficial in terms of the Treasury yield or Treasury prices, which then had a little bit of an impact, sending yields down a little bit, which helped the mortgage market a tad. But elsewhere, I really don't think there was a whole lot, in that statement that the bulls could take away and feel overly great about. The reaction was kind of up and down throughout the balance of the week. It looked like maybe we were going to see some negativity in terms of some of my ratios that I like to follow after the announcement on Wednesday afternoon. But then we had a pretty nice day on Friday. We kind of rebounded, and everything at the end of the week was higher for the most part than it was at the time of the announcement on Wednesday. So overall, not a bad week, but it was options expiration week. And we had our Max Payne session back on Tuesday with our members, and we told them to expect, at least based on what I was seeing, I was expecting a directional move to the upside throughout the balance of the week. And so, was the rally on Friday due more to options expiring, or is it really money rotating in a little bit more bullish fashion? Well, we don't know for sure. We'll find out a little bit more about that in the week ahead. But at least it was better than going down after the report or after the policy statement on Wednesday. So that was I take a slight positive away from the way we finished, but just keeping in mind that it was option expiration week. Let's take a look at how the indices did for the entire week. So we had the Dow Jones Industrial Average gaining 1.2%. That was the big winner. Russell 2000 up about 2/3 of 1%. Same for the S&P 400 mid cap. S&P 500 was up about 0.5%. NASDAQ up 0.25%. And then, of course, transportation can't get a bid, down about 0.25%. Moving on to the sectors, we had the energy group up 3% for the week. So that was the big winner. Energy's been performing pretty well of late, last few weeks. We've seen some pretty nice action in the XLE. Then we had financials, healthcare, communication services, industrials, more value-oriented companies, but some of them aggressive. Nice to see financials, communication services, industrials up there in the top half. But in the lower half, we still saw technology basically flat on the week, so it did not even keep up with the S&P 500. That's been a common theme of late. Technology, of course, represents over 30% of the S&P 500. So if technology is not doing well, it's just going to restrict how much gain we're going to see in the S&P 500. So areas like semiconductors, software, those areas really need to kick into gear in a more meaningful way, get some breakouts above some moving averages, that sort of thing, in order to get technology going if we want to extend this rally, the rebound, if you will, that we've seen off the recent low. Hasn't been a huge rebound, but it has been a rebound. So I think technology obviously is going to play a pretty big role in that. Last week, we did see a little bit of a shift from consumer staples, which is lagging, back into discretionary, which had a decent week. Again, not quite up to par with the S&P 500, but still better than staples. So we had a little bit of a relative rebound in that consumer area where we saw discretionary finally outperform staples. Staples actually haven't been doing very well the last couple of weeks, along with discretionary. It's really been a sell-off in consumer stocks, period, which tells me, that's a signal to me that the market's worried about the economy going forward. That's why I would sell consumer stocks. We saw retail sales last week come in below expectations for the second straight month. So those kinds of signs of a potential economic downturn, I think, is what's causing a lot of the problems that we see in the market right now. Moving on to industry groups last week. So this is the relativity performance chart list, if you will. So it's looking at all of the industry groups relative to the S&P 500, not whether they go up or down, relative to the S&P 500. So they could have gone up for the week and still been an underperforming sector industry group versus the S&P 500. So I just want to make sure that that's clear. So these stocks leading are stocks that had the best weeks in terms of industry performance. Toys, travel, and tourism. Now, that's an area that I really liked about 2 months ago. And then all of a sudden, they lost their breakout level and started coming down when we started to see a lot of money rotating away from growth stocks. And if you think about travel and tourism, usually that's a group that would do well with a strong economy, strengthening economy. And we saw that last week, but that was just a bounce off of the downtrend that we've been seeing leading up to last week. So again, the question in my mind is this, is it a bottom? Are we rebounding? Or maybe was some of this due to options expiring? Difficult to say. Again, we're going to have to follow next week's action and kind of go from there. But travel and tourism, good week. Integrated oil and gas, there's an energy component right there. Gold, I'm going to talk a little bit about gold later in the show. I've been somewhat wrong on gold. I kind of liked it as it was trading near term, but I kept saying that, probably wasn't going to last. Well, some things are changing now that suggest maybe gold has more of a, staying power than I previously thought. But anyway, I'll talk about that a little bit later in the show. Aerospace, electronic equipment, non-ferrous metals, pipelines, another part of the energy group coming back last week. Recreational services, healthcare providers, so forth. If we flip this, what didn't work last week? Footwear. Nike came out with their earnings. Not great. Kind of kicking the can down the road on when we might be able to see some sort of a rebound in Nike shares. And as a result, I think that took the footwear group down. Steel, computer services, water, semiconductors. Semiconductors, I'll show you a chart on this later in the show, but semiconductors going up to that 20-day moving average. It's been trading below it in this downtrend, went up, tested it, could not get through, and it's kind of rolling over. And that shows up here with that 2 3/4 loss last week, 2 3/4% loss on a relative basis. Not really seeing any others worth discussing. We'll keep moving on. So what happened on Wednesday at 2:00? Here's what changed in the Fed statement. So there were really two changes. And I'm going to read first what was in the prior report. So that's what's scratched out here, the lines through. So the committee judges that the risk to achieving its employment and inflation goals are roughly in balance. So that to me is kind of a statement where they feel like they're in control. They're like, okay, this risk is balanced with this risk. Everything sounds, still not quite sure which way they want to go, but they feel like the risks are equal. Then they changed it this last month and they said uncertainty around the economic outlook has increased. Uncertainty around the economic outlook has increased. That's not saying that we're got a problem with the economy. It's not saying the economy's good. It's saying uncertainty. I mean, we don't know. That's the way I read it. I feel like they've gone from thinking that the risks are about even, like, hey, economy, we got to kind of keep an eye on that. Similar to inflation, where we think, maybe we still could have a surge. We just want to kind of watch it, and the risks are even. And now they're saying that one side of that, the economic part, there's uncertainty. They don't know what to feel about it. And that's where I'm having a little bit of problem. And you can see that's the area that the market's having a problem with. And part of it is that they don't feel like the Fed has it under control. Because if you felt that like the economy was weakening and that there was uncertainty, then you would lower interest rates. But they're basically saying, yeah, there's uncertainty there, but we're not going to lower interest rates. So what does Wall Street do? It sells anything that's, interest rate sensitive for the most part. That's what we've been seeing over the past month, from the high, and even before the last month. Last month is when we've seen the S&P finally roll over. But there was a lot of jockeying and rotation that was taking place before the drop in the S&P. Anyway, I thought that was interesting. Wanted to point that out. And then, of course, as I mentioned earlier, starting in April, the committee is slowing the pace of decline of its security holdings by reducing the monthly redemption cap on securities from 25 billion to 5 billion. That's a pretty substantial pace of decline. So that I thought was something that would help with interest rates. 10-year Treasury yield maybe come back down because there's not going to be as much selling. So it kind of changes the balance of demand and supply on Treasury securities. They're announcing they're not going to sell like they have been. So it means there's going to be a little bit more of a shift toward demand versus supply. That drives Treasury prices up and brings the Treasury yield down. And so, and if you looked last week, the 10-year Treasury yield was down. And I'll show you a chart on the 10-year Treasury yield in just a minute. But that to me was a little bit of a bone that the Fed threw over to the housing market because housing's been horrible. So that's the way I read it. But those were the changes. That was basically it. Everything else was the same. No real mention that, hey, we're going to be thinking about cutting rates at the next meeting. Nothing like that. So the market is left with this uncertainty. And what does the market hate more than anything else? Uncertainty. So I just don't think there's going to be the kind of rotation back into the growth that's going to drive the market straight back up. I mean, I'm going to continue to watch it. We'll see what happens. Take a look at the rotation as things unfold. But based on what I read here and the way I believe Wall Street's going to interpret this, I just don't think we're going to see a straight back up move like we saw on the way down. Had they shifted, talked about, hey, we're starting to see a lot more issues with the economy than we do with inflation. And, the committee is beginning to think we need to start moving more in that direction. Anything like that, I think, would have been welcome news for the market. But again, we're just kind of not there yet. 10-year Treasury yield. This is a 5-day, 10-minute chart. So here was the meeting. This was the Fed meeting. And so when they came out, and again, I think cutting slowing the pace of decline of the 10-year Treasury sales, I think that, again, improved that demand versus supply, sending Treasury prices up. And here's the yields coming down. So pretty big move from about 4.33% down to about 4.17 and change percent in the course of just a couple of hours of trading. And we did rebound back from that, but we're still down from where we were on Wednesday at the time of the announcement. So again, I think that was maybe just a little bit of a bone that was thrown over to the home building group. I don't know if that continues or if that accelerates. We'll see as next week unfolds. So now here's the S&P 500. In fact, here, let me make this a little wider so that I get a better view of it. So here's the S&P 500, and I've got this black dotted vertical line at 2 o'clock on Wednesday. That's when the Fed announcement came out, because I like to see what's going on after the announcement. How does the market react to it? And 2.5 days or 2 days and 2 hours is not exactly a huge amount of time, but it's a start. And what I saw are things improving. So the S&P 500 has gone up since the announcement. The QQQ versus the spider has gone up. So a little bit more rotation towards growth. Discretionary versus staples went up. Now, we had some downs in the middle of this period, by the way, but where we finished on Friday, we were up from where we were Wednesday, 2 o'clock. Russell 1000 growth versus Russell 1000 value. Large cap growth versus large cap value is up. Another large cap growth versus value reading up. Mid cap growth versus mid cap value up. Small cap growth versus small cap value up. The dollar up. technology relative to the S&P 500 down. That's not good. And consumer discretion, and that's, by the way, why the S&P only gained 0.5% last week, because you're not getting that lift from technology. We were down from on a relative basis. We were down last week, and we were down from the 2 o'clock announcement. Discretionary versus the S&P 500, though, rose. So we did see a little bit of money finally rotating back into discretionary on a relative basis. But that group's been so beaten down. Friday was options expiration. So I'm not shocked by that development. S&P 500. So this is just the 1-year chart. Wanted to kind of point this out, and a couple of things to watch for. We went straight down. This is our little bounce. I think this was an A move. Maybe this is a B. Perhaps we have a C still to go to the downside. But where do we go to the upside first? Is that it, what we saw last week? Or do we see a little bit more strength? So looking at this, the way I would look at it is, let's pull up some resistance areas. So right here from that gap coming across. So that was the election gap up right there, just under 5,800. I believe that's 5782. The open right here on January 13th, 5782. Now, I want you to remember this January 13th date, because I'm going to talk about this a little bit later in the show, and how we saw a lot of changes taking place in the market. So here was the move up after the election, back down. So we're right back to where we started. And then the next move up, I want to show you some things that have changed from January 13th. Obviously, you can see that the stock market's changed. The S&P 500 went up, and now it's come back down, and it's now trading below where it was. So that's one thing that's changed, but there are others. But I'll get to those in just a bit. Let's move on to, and the 20-day moving average, I think, is really important to keep an eye on. Normally in downtrends, when you go down below, you come up, you fail, you start to move lower again. That's an indication of a trend to the downside. If you go up and below the moving averages like we were doing back in December and January, that's a trendless market, sideways. So moving averages don't mean anything really in a trendless market. But once you start trending like we've done here and already had failures at the 20-day moving average, that kind of becomes an interesting area of defense for the bears. So you're going to see potentially a lot more selling when you get to that 20-day moving average. So you've got that and price at 5782. So for me, that's really the key. And then when we fell back, you can also see coming across here at about 5680 was another support area. So this was resistance, then it became support a couple of times, then we went through it, and now now it's acting as resistance again. So we've got price resistance at these two lines going across, the horizontal lines, and then we've got the 20-day moving average. So this is really what we want to watch for. The other thing that I think is going to be really important is going to be this right here, because now we're seeing PPO improvement. So if we go back down to a new low and get a reversing candle, it could happen with a positive divergence. That's something to keep an eye on, because divergences are important in terms of momentum. And right now, we've clearly, at their most recent low, we had a lot of downside momentum. When we get back down there again, it's possible that that downside momentum has slowed considerably. We'll see. All right, on this chart, got the S&P 500 on the top here. This is a 15-year weekly chart. I want to show you the XLK versus the S&P 500, also rising for the most part. And then I have a correlation. So in this correlation, one second. Just checking one other thing. Okay. So in this correlation right here, what I'm comparing is the direction of the S&P 500 versus the direction of the XLK versus the S&P 500. So as you can see, the correlation is fairly positive, which makes sense. I mean, over 15 years, if technology, S&P is going to go up when technology is outperforming generally. It's the largest weighted sector. So of course it will. So I just wanted to point that out. But you can see there are still a lot of trips in the negative territory or inverse correlation. So technology, it's not always, going up or down. The relative performance is not always going up and down with the S&P 500, but a lot of times, most of the time it is. How about the discretionary group? So here's discretionary going up, coming all the way back down, starting to turn up again at the end of the year, now back down again. So what's the correlation there? Probably not as strong as the XLK, and that makes sense. Why does it make sense? Well, because the XLK is not weighted nearly as heavily in the S&P 500. Technology is over 30%. I'm not sure where discretionary is, but it's probably somewhere around 10%. So these, you're not going, it makes sense to me that the correlation strictly with discretionary versus the S&P 500 is not going to be as strong. So I see a little bit more 50-50, although it still leans toward positive correlation. You can see a lot of these readings above 0.75. How many are below minus 0.75? I see like 4. A lot more are above. So there's still a slant toward when discretionary stocks are doing well. That's generally going to mean good things for the stock market. Now I'm going to show you my favorite intermarket relationship, and it involves the discretionary group. This is the XLY versus the XLP. So now forget about the S&P 500. We're looking at both consumer groups, discretionary and staples, and how do discretionary stocks perform relative to staples, which are much more defensive and value oriented. Well, you can see over time it goes up, but look at the correlation. We spend almost all of our time above zero. So this is the relationship between discretionary versus staples is more important in determining the direction of the S&P 500 than technology, which is over 30% of the S&P 500. It's kind of fascinating. But this 15-year correlation is almost always in positive territory. Only a couple of times, maybe 2 times, have we gone below minus 0.5. So we don't even get to -1 ever. This is like I said, a very, very important relationship to watch when you're, when you're evaluating the stock market. So, and right now that's coming straight down. So it's hard to be bullish the market when you see this ratio coming down as hard as it is. Now it did kind of start to hook back up a little bit last week, but not much. So this is something that needs to improve. Discretionary versus staple stocks. If you're going to get a big move to the upside in the S&P 500, you've got to see this relationship start to change. All right. Let's see. I'm going to move on and go over to our website at EarningsBeats.com. So for those of you that may be new to our shows on YouTube, our EarningsBeats shows, first of all, hit the like button. We'd love that. That would really help us in our algorithms. Hit that subscribe button. Anytime we do any of our live stream shows, you'll be notified so that you can check them out. We do a lot of free stuff to try and help everyone in the market as best we can, especially those maybe that can't afford to pay for our service. So make sure that you like the video, subscribe. And then if you want some more information from us, we do have a free newsletter of our own. If you go to EarningsBeats.com and you scroll down, you'll see an area where you can sign up for our free newsletter. Name and email address, all it takes, no credit card required. You can unsubscribe at any time. And beginning on Monday, you don't see it here yet, but it should be here tomorrow. We are going to have a free live stream next Saturday. And the topic is going to be, is this drop that we've been seeing, is it likely to be a correction only, or is it likely to morph into a bear market? I think everybody's asking that question right now. And we think we have the answers. So you're going to want to tune into that. So make sure you check on our website tomorrow. Starting tomorrow, there should be a link so that you can sign up. Make sure you save your seat. But if you're on your mobile device right now, you can actually use the QR code on your screen, and you can that'll take you directly over. Just scan on your phone that QR code, and that'll take you to a landing page on your mobile device where you can sign up now. So that is set up for mobile, and it should be on our website on Monday. All right, so let's talk about a few more things before we wrap up. I said I was going to mention gold, so let's take a look at gold. I also said I was going to mention January 13th again. And so I'm going to bring up gold and January 13th because, in my opinion, that's when things started to change. Now, whenever you hear me talk about gold, you'll hear me say that gold is a great investment. It's a great hedge when one of two things, preferably both things, are occurring. First, volatility is on the rise because higher volatility generally means weaker stock market, and gold is seen as a hedge against stock market weakness. So anytime that VIX starts to run, we normally see relative strength in gold, meaning that it outperforms the S&P 500. The other thing you need to look for is the dollar. We've been in a rising dollar environment for the last 15 years. And as a result, gold has not been a good investment for the last 15 years. But when the dollar was under pressure and selling off like it was back at the beginning of the century, 2000 to 2010, gold was a phenomenal investment. So you got to keep those two things in mind, volatility and the direction of the US dollar. Now, January 13th, why am I drawing this line? What day did the dollar top? January 13th. That was the time a lot of things started to change in the stock market. So look at the dollar. It was clearly in an uptrend. And then starting January 13th, it's clearly been in a downtrend. And if you look at the volatility index, January 13th, it hadn't gone through 20. But since then, we have seen the move through 20 with volatility accelerating to the upside, dollar accelerating to the downside. And look at gold relative to the S&P 500. There's your relative strength. You know, some were saying back last year that gold was having a phenomenal year. And I just kept saying what was going up, but it was going up same as the S&P 500. It really wasn't outperforming. It is now outperforming clearly. And again, a lot of it has to do with the dollar. If you start seeing the dollar improve, I think if, the Fed starts to talk more about the economy, I think this could all change again and flip back the other way. So it's going to be worth watching. Sometimes the Fed might not be saying anything, and yet it does start to flip. And so what that's telling me is Wall Street is sending the Fed a message that they need to change. They need to start looking more at the economy. So, or at least that Wall Street believes that's what the Fed's going to do. Now, this Fed's been waffling and back and forth. I'm not sure how much confidence Wall Street has in this Fed, but those are some things at least that we can be looking for. But gold is broken out. We went above $3,000 an ounce for the first time in history just this past week or two. Relative strength looks good. And again, if volatility stays up, I'm going to say above 17 area, that would be a good environment for gold to continue rising. And if the dollar keeps going down, that is absolutely going to have a big impact on gold going higher, in my opinion. So those are a few things to watch with gold. S&P 500, how about that January 13th date? Here's the S&P 500 relative to the German DAX. So the US stock market, German stock market. You can see US stock market was doing pretty well, right? All the way until November, things started to deteriorate. We had a breakout above this 0.29 level back in June of last year. Came down, we tested it in December, and then we finally broke down below the 0.29 level. When did we do it? January 13th. January 13th. Lots started changing on January 13th. Big move to the downside in the US relative to Germany. A couple more groups I wanted to just go over real quick with you. Semiconductors, I mentioned earlier, they had come up, they'd hit the 20-day moving average, they'd rolled over, started to roll over, and you can see that here. You also can see that our prior low right here was just below 18,000. Prior low back at the beginning of October, just below 18,000. The recent failure to the upside, just below 18,000. Where's the 20-day moving average? Just below 18,000. So I think if I ask you where's the key level in semiconductors, hopefully you would say just below 18,000. So if you get back through 18,000, that'll be a good short-term sign for semiconductors and for the overall market. Semiconductors play a big role in the market. I think semiconductors are 11% of the S&P 500 and 25% of the QQQ, or the NASDAQ 100. Might be a little off because I did those calculations probably a month or two ago. So maybe it's a little off, but it's still a very hefty portion of both of our key indices that we like to follow at EarningsBeats, S&P 500 and the NASDAQ 100. So we get a breakout on semiconductors, we want to know about it. That can have a nice impact on the overall market. If we fail, however, and start rolling over and make new lows, take out the early March lows, that obviously would be the opposite and would suggest that we've got more downside in the market. Software, another group I'm following pretty closely. We came down, we had a big gap down back on March 10th. We made our way all the way back up. We filled the gap. We also got close to that falling 20-day moving average. Have not been able to get through it, so I'm going to throw that number out there again. The 20-day moving average on software, which is at 68.09. Right now we're at 67.52. So we got about 1% of upside in software until we make a pretty big test. And then again, can we get through? If we do, then I think, brings into play possibly the 50-day moving average, which would be up another probably 4 or 5% on software, and probably a similar amount on semiconductors. And that could put light a fire under the major indices to give us a little bit more of a rebound than what we're currently experiencing. So these are going to be two key groups, semiconductors and software, to keep an eye on as we go into next week. All right, last one. I just wanted to point this out because we do a lot of research at EarningsBeats. And my son, Tyler, who many of you know, helps me with the YouTube videos, also helps me with a lot of my research. And he was looking at some of the bigger names, and we're looking at 2025 price action on these names, mostly like Mag 7 stocks, and then a few other big companies. But what we're looking at is how we're going down, not just that we're going down, like you can see here in 2025. Nobody's going to argue, if you have Microsoft in your portfolio, you've lost money since January 1st. Price has gone down. But has it been pure distribution? Are there signs, maybe, even though prices are going down, that Wall Street's starting to accumulate one of the leaders like Microsoft? I would argue that, yes, that is the case, that we are seeing accumulation in the stock right now. First thing we can do is we can pull up a relative chart that shows you the AD line. Now, if you look at it, we just had a new all-time high on Friday in the AD line, accumulation distribution. And if you know sort of how this works, it's basically if you trade better in the afternoon and you finish in the top half of your candle for that day, or better yet, all the way at the top of the candle, then volume gets added to the AD line. And when you finish in the bottom half of the candle, and especially all the way at the bottom of the candle, your volume gets subtracted. Volume's the multiplier. So volume gets subtracted. And so I'm looking at this, and, we were up near the all-time high, or at the all-time high, when Microsoft is $446, $47 a share. And now we've come all the way back down, hit a low down around $377, finished at $391 on Friday, and we're setting a new high in accumulation distribution. And so that had me thinking, how has Microsoft been trading intraday? Well, here is Microsoft's intraday action. So every day this year, what Tyler had done is we put in the opening price, the 10 o'clock in the morning price, 11 o'clock in the morning price, 2 o'clock in the afternoon price, and then the closing price for every day. And then we come all the way down. We finished all the way through Friday. And so this first line right here, this row coming across here, totals all of the changes in each one of these time periods. So essentially what we're doing is we're taking this, putting it over here. So at the opening bell, this was the change. So, and that's taking the close on January 2nd at 417.74. subtracting that from the gap up to 420. That difference is $2.50. And then from the opening bell till 10 a.m., it went up $1.41. Well, there's your $1.41. And then from 10 o'clock to 11 o'clock, it went down $1.16. There it is. So we did this for every day and then came down, and this row right here adds up all the days, that particular time period since the beginning of the year. And what it shows is that Microsoft has gone down $26 from $417 down to $391. That's $26. Do you know that if you add up all the gaps on Microsoft, that it's gapped down $49? Meaning that the rest of the day, we've seen recovery, and especially from 2 o'clock to 4 o'clock. We've gained $26. Now, Microsoft's gone down $26 from beginning of the year to March 21st. And yet, Microsoft's gone up $26 from 2 o'clock to 4 o'clock. Stock's gone down 26, but in the last 2 hours of the day, Microsoft's gone up 26. That's a lot. And it tells me that there's probably quite a bit of accumulation taking place on Microsoft. Institutions don't care if the price goes down a little bit, for 3 or 6 months. Individual traders, especially short-term traders, that freaks me out. I mean, I don't want to see, short-term, my stock go down $26 and me ride it the whole way. But if the stock's ultimately going to come back up, institutions don't mind buying it as we're falling, buying it at these cheaper prices. And then at some point down the road, when Microsoft rebounds, reaping all the rewards. That's how Wall Street works. That's how the institutions are able to accumulate shares. So that's during 2025. Now, since the S&P 500 all-time closing high on February 19th, this is how it looks. So again, from February 19th, now that's not Microsoft's all-time high, it's the S&P 500's all-time high on February 19th. Microsoft, since that date, has gone from 413 down to 391. So it's gone down $22. And if we were to add this across, it should equal $22, $22.68. So that's how much we went down. So it's probably 413.94. Right there. 413.94 minus 391.26 equals 22.68. And here's your distribution since February 19th. Gap downs. Remember, we've only gone down $22, but the gap down's been down 24. First half hour, that's what I call amateur hour. That's where a lot of traders are reacting to the news. It's the media telling us how bad everything is, whether it's, inflation, whether it's the tariffs, whether it's Trump, whether it's this, whether it's that. Doesn't matter. It's just news. And I'm not saying Trump. I'm not trying to throw politics in there because I wouldn't care if it was Biden. It wouldn't matter. If you're going, when the market is trying to make money, you're going to see these headlines as bearish as humanly possible as we get down close to bottoms. Because that's when the gap downs accelerate. The morning action is weak typically, and then we get afternoon buying. All of a sudden, everything's better in the afternoon, and Wall Street's happily buying shares discounted. So just thought it was pretty interesting that since the all-time high on February 19th, we've gone down $33 by 10 o'clock in the morning, only to recover 11 of those dollars by the end of the day. And in the final 2 hours, it's gained $15.63 during a period when the stock's actually gone down $22. Pretty amazing. But how about since March 3rd? So let me go back and show you that chart. So here was March 3rd. I thought I had annotated this, maybe not. Anyway, March 3rd is this big red candle. Let me zero in here. So here was the big red March 3rd candle. Since then, you can see we were at roughly 388 and change. Now we're at 391 and change. So we've gone up like $2, $3 since March 3rd. Now that you see that, and by the way, look at all these big hollow candles. Lots of buying intraday. So since March 3rd, what I'm doing is I'm adding up March 4th through March 21st in each of these columns. And this is what's happened in total. Since March 3rd, we have seen the market go up $3. But look at the gaps. Microsoft, even though it's gone up $3 in roughly last 4 weeks, 3.5 weeks, whatever, opening gaps are down $28. And yet somehow we've gone up $3. It's been basically buying the rest of the day, especially in the final 2 hours. Look since March 4th. These are the 2 o'clock to 4 o'clock changes every day. I notice one day in that period where it went down. Every other day in this period, we've gone up from 2 to 4 o'clock on Microsoft. I think the stock's being accumulated, even though price keeps going down. Why? Because of the negative headlines, because of the gap downs. This is, to a lesser degree, exactly what we saw back in 2022 when I called the stock market bottom on June 18th or whatever it was, literally right on the day. I think maybe it's 17th. And I was pointing to the same stuff. This is how Wall Street gets our money. This is how Wall Street does well while everybody else struggles to make money in the stock market. If you don't understand how this works, you're going to have a lot of problems investing. You got to see this and you got to be ready to act on it. I actually started building a position in Microsoft. I'm doing what Wall Street's doing. I'm not doing what the media is saying or even what Wall Street is saying through the media. I'm doing what Wall Street is doing in the charts with their money. And that's what you got to do. Now, again, I'm not saying Microsoft doesn't go lower. If this market goes lower, I absolutely think Microsoft is going to go lower. But if we continue to see it going down because of manipulation, I'll continue to add until ultimately we'll reach a bottom and we'll see market rip back up to the upside. If there's one thing I've learned about the stock market over the years is when the selling is over in a correction, or especially in a bear market, when that ends, some people say, why do you try to call the bottom? I'm like, are you kidding me? The best gains are made from the bottom. Why wouldn't I want to call a bottom? And if I can see signs that help me point toward a bottom, why wouldn't I want to use that? What do I want to wait until it goes back to an all-time high and then say, yep, I was right. It went down. Now it's over. And now we're breaking out again. So now let's start buying. I think I'm going to do a lot better if I can buy when the market's down. So anyhow, that's the big thing we got right now. Is it distribution? Are we done with distribution? Or are we going to continue going lower with more intraday selling? Or have we now morphed into a period of manipulation where the media is manipulating all of us, forcing gap downs, but then buying rest of the day? So anyway, when we get all this information, it'll be something that's available to our members at EarningsBeats. So you might want to think about signing up for a 30-day trial. I'm going to continue to monitor this. I have information on some of these other stocks. I just wanted to point out Microsoft for now. I thought this was just blatant manipulation on the stock. And we'll see what happens from here. Anyhow, that's all I got for you today. I really appreciate you tuning in. I'll see you all next weekend. Happy trading.